Well, hello everyone. Welcome to Trading Price Patterns. My name is Barbara Armstrong. I'm a coach with Schwab. Delighted that you are tuning into this session. Today we're going to talk about going with the flow. And what do I mean by that? I mean that we're going to look at what's going on in the market, and we're going to try and take advantage of that by using trading strategies that aren't trying to buck the system. And by that, I mean, we're going to look at what is the flow of the market in general, which sectors are driving that flow, and then can we find some stocks within that, those sectors that might be leading the charge or contributing to what's going on. So just in case you were wondering, we're going to be looking at some bearish opportunities today. And that isn't to say that bullish opportunities don't exist and aren't out there. There are, and they do, but this is going to be our focus for today. If you are not following me on X, I encourage you to do so. We've also got the privilege of having Mr. James Boyd with us in the chat, and he posts so much great content on X, guys. If you aren't there, you're missing out. So James Boyd CS and Barb Armstrong CS. I did my first little short Twitter video yesterday on, basically sector analysis and how you can find strong sectors and then stocks within those sectors. Today, we're going to look at the flip side of that, but it's a little 2-minute video on X, so I encourage you to check it out. I posted it, kind of late yesterday. Okay, so having said that, let's get into things. Know that, options do carry a high level of risk and aren't suitable for all investors. You also have to apply for option trading privileges with Schwab, and not all will qualify. Schwab doesn't recommend the use of technical analysis as a sole means of investment research. We want to be aware of what's going on in the world. We want to pay attention to earnings season, which we are now, sitting, at the front end of. It just seems like the last earnings season just ended. So maybe it's just me. But yeah, so, a lot of the banks and Netflix is coming today with earnings. So, and these things can all have an impact on the markets. We use the Paper Money software application on the Thinkorswim desktop platform, which is a brilliant place to learn and hone your skills and make sure you understand, your trading plan and what you're doing and the mechanics of how to place your trades on the Thinkorswim platform before you go to your live account. There are some nuances and differences. One is that short options will never be assigned early. In Paper Money, that can happen in a live account. Have I seen it happen? Yes, I have. Yeah, so somebody's asking about Jerome Powell and when he's speaking. He is speaking in half an hour. At 1:30 Eastern, 11:30 Mountain. So, hard to believe he has the nerve to be speaking in the middle of my webcast. I know you're probably as shocked as I am, but there you have it. Okay, so we're going to do a bit of trade management. We're going to go out and look at what's going on in the market, and we're going to spend the rest of the time placing new trades. But what we can see here, is kind of a trend continuation pattern, right? So, the market hit an all-time high on the 19th of February. And it's been kind of rolling down the hill ever since. And, as with many hills, it's not just straight down. There have been, some attempts to recover along the way. But by and large, down, we tried to rally, down again, tried to rally, down again, attempt to rally. And, we have that classic close below the low of the high day. And so it looks like this downtrend may be continuing. Now, I just taught Ben's trading index options class, and he has this specific 2-week plan, which is really interesting. So if you missed that class today, you may want to go back and watch it, where we were looking at something at a delta of 15, which is a higher probability trade. and 15, a delta of 15 means, that if the stock goes up by $1, the value of this option will go up by, 15 cents. But it also is used as a rule of thumb for probability. So we've got about an 85% chance of that trade working out. And so, we can look at indexes, within this class as well. We just haven't tended to do a lot of that. And this delta at 15 is higher probability. We're going to get less premium for it. But if you wanted to take, your technical analysis into account, where might one consider placing a trade? Maybe here, somewhere above that 54.60. But your probability of success, or your delta goes up by about 100%. You go from 15 to 30, if you're looking here. But I mean, the net of this message is that, we're downtrending. At one point, we were down here, over 20%. So we're definitely in bear market territory. Even with where we are today, off the highs, we're down 13%. So correction territory for sure. There's just so much uncertainty in the market. Somebody posted in the chat earlier today that they think that some of this tariff stuff is going to be, removed. But I think there's still so much uncertainty in the market over what the government will do next. And the market doesn't like uncertainty. And so, there can be some, it's not as if a decision is made that there's, immediately going to be a total trend in direction. Now, having said that, I was in New York on Friday having fun, and look at this candle. I mean, one of the biggest up days we've seen in the last 20 years on the S&P 500. But we had this big up day, and then pulled back, which is, kind of to be expected. And could we see, kind of halfway through this candle as being a potential support level? It could be, but, now we're pulling back. And although we had a big up day, is this a trend reversal? We're still below the 200 and below the 30, and we're heading for the 10. How about the NASDAQ, which is our more tech-heavy index? Pretty similar looking chart, right? And, when we come and we look at this, this is down 17%, even with this latest rally. And at one point, down 25%. And, so like, as I've said a lot lately, how do we hug a porcupine? Pretty carefully. But, if we're looking at what's going on in the market, and then we look at our small caps, kind of more of the same, right? And our Dow 30, similar patterns all around. Although this one is down less. But still, 11% is not nothing. And at one point from here, down 19, close to 19. Now, what's cooking with the VIX, our volatility or fear index? It's now up. Now, it's interesting because when I looked at this a little earlier, it was down a little bit. So it was down at this end of the range. But, 30, I mean, we're in the nosebleed section here. If we look at the last 2 years, how often have we been above 30? Not often. Once. Back in August of 24. So we are in a high volatility arena here. And so what might we choose to look at? Well, we might choose to look at selling strategies. And if the market is moving bearishly, one of the things we could do is come and look at our sectors and say, well, if the market is overall it's been moving bearishly, who's been leading the bear brigade? Well, consumer discretionary is, has been in last place over the last 3 months, followed by tech, no big surprise there, and then energy. And then how about over the last month? Well, energy, tech, healthcare, and materials. So energy and tech, have really been on the struggle bus. And so, might we look at, some tech opportunities and, and then, consumer discretionary opportunities. And if we look at a consumer discretionary stock like Target, which, has had a lot of talk today, and we're looking at a stock for the last 6 months. I mean, it has been on a steady downtrend. It's down 32% year to date. So it is, outperforming, if you will, the NASDAQ and the S&P 500 in the lead to the downside, in that it is down much more significantly than these two indexes are. And, if we come and we look at this, series of bear flags, it's below, draw a trend line, it's below all of them. And then today, Goldman Sachs downgraded this stock, and their original price target was 140, and they've dropped it to 101. Like, that's a huge drop. And, it's like, well, kick a man while he's down. It's sitting at 90 right now. And so their target is a little bit above that, but could we look at this? And again, we're in earnings season, so earnings is coming up May 21st, but could we look at this and maybe sell a short call vertical to take advantage of the higher volatility in the market right now? And might we look at something at around this $98 level? Now, if we come and when did I say earnings was? May 21st. So if we come out here 23 days, we've got dozens of contracts and actually, a relatively tight bid-ask spread on these. And where did we want to be on our short call vertical? We wanted to be at 98 or above. And so if we look at this now, what's the difference between the weeklies and the monthlies? Well, one, you have to do a $5 wide spread. So that makes it tough, because if you want to be above 98, then you have to go to 100, and you're likely just not going to have enough premium. So if we look at going to the monthly, we'd only get 69 cents on so we're risking 431 to try and make 69. There's not enough premium in it for us. We'd have to go so far above, with a delta or a probability of it expiring in the money of being 17%. So if we come out here to 98, our probability of it expiring in the money is 21%, but we have perhaps a better shot at earning enough premium to make it worth our while. So if we went to 98 and 100, that would be 45. And if we look at this and say, okay, 45 cents, let's switch this to our calculator and say, if I can make 45 and I'm risking 155, I've got a 29% return. And for a trade, we'd be in for 23 days. So our kind of rule of thumb here is, if we're in it for 25 days, we want at least a 25% return. So this is an acceptable level of return. How much are we risking? Well, we're risking about $160. So how many of these could we do if we don't want to risk more than $500? Well, we could do 3. So we're going to change this to 3, which means we're risking $477 for the opportunity to make 123. Now, why might someone choose that? Well, because it's a higher probability trade. And by that, I mean, we've got only a 21% chance with where the stock is currently trading of the trade going against us. And it's trading at 91 right now. So we've got $7 worth of wiggle room. This is a neutral to bearish strategy, but as long as it stays below $98, we're okay. So it's less directional. Okay. So, and we are going to put in an order to exit when we've got 80% of our max gain. Now, why not just like monitor it? You're going to look at it every day. Well, I'm going to California, this weekend. And so, I may not be looking at the market. And maybe if this really drops tomorrow and then rallies, or drops on Thursday, well, today is Wednesday, or drops on Monday and then rallies, I could be out with my 80%. And by the time I get around to looking at it, it's back up, much higher. And so I'm just trying to take advantage. Now, does this mean if on Monday or Tuesday, when we look at this, maybe we've got 60% of our max gain and we might choose to take it? Can we go in and change that? Absolutely. Okay, so confirm and send. We're going to put this in our short call vertical group. And, have we traded other, short call verticals? Well, we have a whole pile of them right here. And, Starbucks is at 57. We have Amazon that's at 68. And, we have a target to get out at 80, but today Amazon is falling, or I'm assuming it's falling, which is, why that's gone up in value. So, could we choose to exit? Because we do have a pretty decent return on it. We could, but what have we got coming up? We've got a long weekend coming up where on Friday, the markets are closed for Good Friday. So we have 3 days of time decay coming our way when the market is closed that might help us get towards our goal. And so on Monday, if it hasn't hit our goal, might we revisit this? Absolutely. Yeah. All right. And so, we could, although we could exit this, we could say, I'm just going to be patient. And then American Express is coming with earnings tomorrow. And we don't like to hold these over earnings. And so we might just say, hey, like, where are our strikes on this one? I'm surprised. Okay. So, we might say, hey, I think with the market and American Express is popular with a lot of travelers, travel may be down. So, I think the stock could go down. And it has been downtrending, but what if it gaps to the upside? So this is one of those decisions. And in our example trading plan, and some people will do these trades as an earnings trade, because, you're going to go in and then there's going to be this implosion, this volatility, typically post earnings. And, that is not helping our cause. And our strikes here are at 255 and 260. So we're in between the strikes here. And, we're still 9 days away from expiration. But, if this falls, we could have a profitable trade. If it doesn't, we could be closer to our max loss. And so if we say, hey, our rule is we're not going to hold this over earnings, then we would close this out. And we're down $112, but, this is a $5 wide spread. So we could be down another 240. And so I'm going to come up to American Express and we are going to cancel and replace that, and we're going to exit that position. That's in our short call verticals, and the rest we will leave. Okay. So a little bit of trade monitoring. Let's go and look at NVIDIA, because there's been a lot of talk about NVIDIA in the financial press today. You know, their sales to China, you know, have had some additional constraints put on them, and they're, you know, a big part of their market. But the reality is, since the beginning of the year, you know, this stock has been downtrending in, you know, in a downtrending channel. And as good as this company may be, this is what's showing on the charts. And you know, today's, you know, candle being down 7.7% is implying that maybe there may be more tough times still to come. And so again, could we look at this and say, could we come up here to this 114, 115-ish level and think, hey, this may stay below here for, you know, the next 2 or 3 weeks. And so let's come up and have a look. Do we have earnings? I think earnings on this is still 6 weeks away. So May 28th. So, and this is very heavily traded. And so could we come up, and we could look at the monthlies. So we're 30 days out on that. And, you know, where the weeklies have thousands of contracts. So could we do this 115? We have a 2 cent bid ask spread, the 115 and the 120. Ooh, that's not a lot of premium. So if we say, okay, well, let's go out to the monthlies. You know, we're getting $1 on this. Let's see what our, so that's a 25% return on our risk. And we're looking at the 115. So our probability on that is only 22%. And look at it, I mean, we've got 50,000 contracts on the books, 14,000 contracts traded today. So if we look at this and we say, okay, we've got a 25% return for a trade we would be in for 30 days, that doesn't quite meet our requirements, does it? And so we might just say, yeah, sorry, we're close, but no cigar. So the next question is, well, would we be comfortable trading something like the 110? Because this is at 103. And if you say, yeah, I don't think so. It's come up to this 115-ish level a couple of times. I'd rather not. Now, but could we, on the other hand, look at this and do, you know, a 1 ATR, thinking this may continue to fall for another couple of days, you know, and so could we look at it that way? So if we come to our trade tab and look at, could we buy a put? And let's just, because we're going to be looking closer to the money. And if we come out to May 16th, so we've got 30 days, even though we're only intending, could we do this kind of 1 ATR strategy? So if we bought a put at 100, we're risking $495 to $500. We've got tons of volume here. So that's doable. And then what would our 1 ATR be? Well, our low today is 103.15. So we would take our 103.15, and this stock on an average day has moved $7.66. So we're going to subtract that. So 103.15 minus 766. 95.49 is going to be our target. So let's just put this into the, let me switch this. There's our vertical on American Express. Yesterday we talked about Fibonacci's for James Fibonacci Boyd. Yeah. Okay, so this is a 1 ATR bearish example on NVIDIA, where the 1 ATR is $7.66. And I got that from here because it's right on the chart. If we hover over today's candle, so we're at 766. So our target is just to say, hey, if it moves down like about what it moves in an average day, and today it's moved how much? $7.64. Kind of interesting, isn't it? So it's going to be today's low, 103.15 minus 766. Now, some will just take the current price, and that's totally legit too. They're in this instance, they're pretty close together, 95.49. And our exit would be, if we take today's high, and that is 106.79, and we're going to add 766 to that. 106.79 plus 766. Okay, 106.79 plus 766. And that is 114.45. Yeah, so average true range. If you're not familiar with this strategy, it was one I learned from actually, he's now a manager on the coaching team. His name is Scott Thompson, and he used to have a class just dedicated to, trading based on average true range. So if you come to the studies, edit studies, and just type in ATR, actually, you don't even have to do that because it's right at the top. Then if you click on this little question mark, it will give you a pretty, complex definition of what this means. But basically it's how much the stock moves from top to bottom of the trading day, from the high to the low of the day. And I don't know why that isn't loading. And then you can just here add selected and hit apply and okay. I already have it on my chart, but this 14 means over the last 14 days. And, that's the default. I figured there's good reason they choose that as a default. This is a short-term trade. If all goes according to plan, we could be out of this tomorrow, or we could be out of this on Monday or Tuesday. The plan isn't to be in this for weeks. The plan is to be in this for days, maybe to a week. Okay. And so our target, just use this line for our target, is going to be 95.49. So we can just 95.49. If you just want to see it on your chart, this is our ATR target. Show it on the right. So if it basically comes back down to this resistance line, doesn't even have to come all the way, we would have a profitable trade. But how much could we lose? We could lose the entire amount that we are investing to open the trade. So we want to buy a single, and then we're going to come down to first trigger sequence. We're buying a put. Why? Because we're bearish. In the short term, we're creating an opposite order, that we're making a market order that is good till canceled. And then we are going to say, hey, if and when this goes at or below 95.49, get us out. Or if it goes at or above 114.45. Oops. Save, confirm and send. And we're going to put this in our long put group. And we're going to put in the note here that this is a 1 ATR target and exit. So that if we come back and we're going, why did we pick that target? And then where can you see that? Well, one, on the monitor tab, we could add it as a column, but also if we come here and we look at this trade and we look at so we've opened our position here, we now have an exit here, and you see this little envelope. If you click on that, it will tell us, okay? Now, when you're buying something, volatility tends to work in your favor. Now, where it can hurt you is if this were to fall and volatility were to drop instead of go up. But the expectation typically is that if a stock is falling and if the market is also falling, that volatility is more likely to go up than down. And when volatility goes up, or even if it just stays the same, but when volatility goes up, the price of options tends to go up. So let's say this goes down and hits our target of $95 by Monday. So we're going to come out here. How might that work out for us? So we're going to come to Theo Price. First thing we're going to do is hit reset. So today's the 16th. So if, let's say on Monday, this comes down, so we're going to be a minus. We wanted to get to 95. So let's say it comes down by $9. I'm just going to hit enter, not reset. 94.32. So that would have hit our target. And you'll notice here on your option chain, whoops, dang it. Okay, just one sec. On our option chain, you'll now notice a new column called Theo Price. This is saying, hey, if on Monday, and this is with volatility staying exactly the same, this would be worth about $9.09. So we'd have almost a $4 gain on a $5 investment. But what if it goes the other way? What if something comes out and this thing rallies, and instead of going down by $9, we were at 114, it goes up by 11. Which is where our current exit is. Now, the idea with this strategy is you are going to adjust your stop tomorrow or your exit. If this doesn't go down and hit the target tomorrow, we're going to tighten up this stop. So our stop should not still be here by Monday, but let's just say for argument's sake that it is. So this $5 option would be worth about $1.70. So we'd have lost far more than half, probably 70%-ish? So it cuts both ways, right? Right. Okay. So that's that one. Now, are there other opportunities? Well, let's look at CrowdStrike. Now, this is, when I look at this one, is this a significant downtrend? And I look at this and go, yeah, not really. When I'm playing I Spy with my little eye on this one, I look at this and I think, hey, I see a double bottom here with a breakout and a retest in this candle pattern. If this, in fact, this range becomes a new support, might be indicating that this has found it. So even though, and if you're not familiar with this company, it is a tech company. So the market's down, tech has been leading the way to the downside, but this stock is not really participating to the degree that NVIDIA, let's say, has been. It's up 10% year to date. Where when we look at NVIDIA, it's down 25. And when we look at the NASDAQ, it's down 13. So would you really want to place a bearish trade on CrowdStrike today? I say nay, nay. Yeah, I don't think so. To quote John Pinette, just a comedian that I really enjoyed, not, a financial pundit. Now, on the other hand, if we look at AMAT, is this kind of going with that flow of market is down, the tech sector down, this stock down, down. So, this is kind of more of the kind of flow that we be looking for. So, and how much is this down from this high at 200? Well, at one point, oh, dang it. It was down almost 40%. Like, ouch. That is, that's a whole lot of pain. And so, could we look at this again, high, lower high, lower high, lower high. And now, today, we have it's trading below the low of the high day. And you may say, dang, we should have placed this tomorrow. Well, yeah, we should have done a lot of things a lot of times. Like the best time to plant a tree was 20 years ago, but we weren't meeting yesterday. So here we are today. And so the question is, if you think it may rally, where might it rally to? And if you're saying, well, this seemed to have trouble getting above the 30-day moving average. So if we say we want this to be above that 140, 7 level, we have earnings coming up on the 15th. So we may not be able to do anything here, and if we're saying we want to be above that 146, 147 level, here's 146. I'm going to come back to, we don't have a lot of volume here, and we've got a 70-cent bid-ask spread. So that's just a little bit too wide. Here we've got hundreds of contracts, 20-cent bid-ask spread. Could we come up to the 150 and get enough premium? $1.40. And so May 16th, I wrote it down. This is May 15th. So it's the day before expiration, but could we close it out before? We could. Yeah. So let's look at that. So 140 divided by 360, is there enough premium in it? 140, I think just barely. I think we're just squeaking through. Oh, 38, that isn't squeaking through. We blew by our target of 30%. We're at 39%. But how many contracts? We're going to do just one because we don't want to risk more than 500. I'm treating this as kind of a companion class, although we do on occasion place other trades, that don't, that would be more congruent with a larger account. But we're going to put in our goal of an exit at 80%. So we're going to make that, I'm rounding to 140, making this 28 cents. And we're putting that in our short call vertical group. And it's currently trading at 139. So we have almost $11 worth of wiggle room on this one. If we're at, AMAT. Yeah, we're at 150 and 155, and we wanted to be above 146. So here's our short call vertical. May 16th, show on the right. Okay, so that's really at the top of this, big candle. And support isn't a finite number, but, we've seen, old floor, old support, which this appeared to be, can become a new ceiling. And it's come up now once, twice, and bonked its head on 150 and hasn't been able to get through. Okay. So I had one other trade, and now we're going to go back to the bullish side of the street. We did a a trade with a caller. So, and I know this is a popular strategy or a strategy, it's not that it's popular, but it makes sense when we're in the kind of market we're in, and that James has talked a lot about this in his classes. So we looked at Celsius Holdings, and if you're not familiar with this company, we had this big period of consolidation, a big kind of cup and handle. It broke out. We put this trade on, so we bought shares and then we sold a protective put and bought a covered call. And are we going to be bummed if we're called out? No, we'd be happy campers. But we've got earnings coming up between now and then. And this one is just kind of trucking along. We're up a very modest $25. But given, what's been going on in the market, are we okay with that? We are. Okay. So what have we done today? Well, we closed out our position on American Express. Why? Because earnings is tomorrow. We placed a short call vertical on Target based on, the trend and the news of the downgrade today. We bought a put on NVIDIA, and then we did a short call vertical on AMAT. And the whole context of our conversation today was to kind of look at if you think of the market as a river, to look at the flow of that river and to get into the kind of fastest part of the current and not try and swim upstream. I don't know if any of you have ever tried to swim upstream, or, I was a very avid canoeist for about 2 decades, and paddling upstream is a lot of work. It's way, way easier to get in the flow of the river and let the river take you there. And so this is our attempt to get into the flow of the river. Okay. So guys, I know I was looking at the chat, so that's why I wasn't looking at the camera. I just wanted to make sure that if there were questions that I had answered those. So I think we're squared away. But there is a survey in the chat today. So here's my ask as we wrap things up. If you would fill out the survey, there are 2 questions. One, means I hated it. 10 means I loved it, and then there's everything in between. There's also the ability to put comments in there. So if there are topics I haven't talked about lately that you'd like me to cover, let me know. If you like the pace, let me know. So I promise if you fill it out that I'll read each and every comment, and so will the management team. If you'd hit the like button, it not only lets James and I know that you like the content, but it also helps move this up in the algorithms on YouTube so more people can find it. So that's number 2. I know I get a little bossy at the end. Subscribe to the channel if you haven't done that already. And then last but not least, get out there and if you're not already following us, follow us on X. James had a great post about JAX today. I'm going to post something I saw in New York last week, but I posted that short video yesterday. You'll want to check that out. It's on kind of today's topic. Barb Armstrong CS, James Boyd CS. So see you in a webcast coming up soon, my friends. I hope you enjoy the rest of your day. Bye for now.